And this is why, as we're looking at S&P 5,000, that's great. It's great we're at 5,000. Starting on Monday, we're going to be reducing exposure to a lot of stocks and rebalancing risk in a portfolio and raising a little bit of cash. Don't know when we're going to get a correction, so we're not going to do a lot. It's going to be we'll do a little bit here and a little bit there, but the goal will be, as the markets continue to push higher over the next month or 2 months or however long it is, we're going to start using more and more of that rally to reduce risk, rebalance the portfolio, and getting set up for what we think will be a fairly decent correction sometime over the next several months.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart, welcoming you here at the end of the week for another weekly market recap featuring my Dionysian friend, Lance Roberts. Lance, how you doing, buddy?
Dude, you're really reaching. How are you today?
Hey, we're going to find out exactly how low this barrel goes.
Yeah, I don't know why you're calling me Denise, but okay.
Yeah. Dionysian, which for those that aren't familiar with their Greek mythology, which was the Greek god of basically partying, of the wine harvest and other things as well. But we're here talking on the day after the S&P finally hit 5,000. So yep. I know that you guys got your S&P 5,000 party hats on there at RIA.
Yep. Actually, I was going to have one made and I couldn't get it here in time for the show. So. But yeah, I actually wrote about that on Tuesday. I said, this is where the media gets to pull out the party hats. And I was trying to get one done and couldn't get it turned around fast enough.
Well, you know what? If you bring it out next week, we'll still celebrate. Post with you. All right. Well, look, I want to talk about what that means. We've mentioned on this program that markets are obviously driven by psychology a lot of the times, and there's this psychic proclivity for big round numbers. They tend to act like a tractor beam. But once they get hit, is that a buy the rumor, sell the news type of event, or does that give a green light for things to run up even higher? And we have some people out there really saying, hey, this is just a milestone on the way to a true full-blown market meltdown. Very quickly, folks, I just want to note there have been bad storms in California, as I'm sure most folks are aware of. The broadband in my house here has been affected by it. If this turns out to my video turns out to be sluggish or fuzzy or whatnot here, just hang with us. We're going to do the best we can here. But Lance, back to S&P 5,000, and I don't know if you want to pull up your regular charts or not, but how notable is this, and what do you think the markets are taking from this? Are they taking a, hey, we hit our goal, we're going to take a pause here? Or is this just feeding the beast and the hunger is for higher?
Well, in the short term, markets, often when you hit big round psychological numbers like 1,000, 2,000, 3,000, you tend to get at least a short-term push higher. Over the next 6 months, you would expect the markets to be a little bit higher. Now, again, there's all kinds of things that factor into that. But, I wrote an article about this very thing on Tuesday, and let me share my screen here real quick. But we actually put together some charts on this and saying, okay, look, this is great. We're hitting, S&P 5,000. We tried this back in late 2021, early 2022. We got to 47.96. Everybody was convinced we were going to 5,000. That was, of course, the peak of the market, and then we had a two-year correction. So I wrote this on Tuesday, so we hadn't quite hit 5,000 at the time. We've crossed that on Friday. But, this is just kind of that thing. But, we in history and look at kind of when these milestones are made, it took almost 9,000 days for the S&P to hit 1,000 on the index. It took half that amount of time to reach 2,000. And we've subsequently continued to reduce that amount of time between these milestone marks. And the difference is, obviously, is that since 2008, the Fed's been hyperactive in the markets versus they weren't active at all really prior to the bottom of the financial crisis. So what will 43 trillion in liquidity get you? It gets you a very quick ramp up from 2,000 to 5,000 on the S&P. So, we're making these these milestones much quicker. But what's important to note is that, yes, when you hit these milestones, markets tend to move a little bit higher in the short term. And you'll notice back in 1995-ish, we did have a decent correction after that. And we had the final melt up into the 2000 .com crash. But again, that first milestone of 1,000 was also pre the peak of the market in the .com crash, and then basically 15 years of going nowhere. Once we hit 2000, we then had a correction, a decent correction in 15 and 16. That was about a 20%, actually 20% correction at that time. When you hit 3000, when you hit 3000, you had basically another correction, and then ultimately we wound up in the 2020 bottom. We went to 4,000, and now we're at 5,000. And of course, 4,000 we hit, just prior to going into the correction over the last couple of years, and now we're at 5,000. So the point is that these big psychological numbers, they're fine to obtain, but remember, it took a lot of buying to get there. So the question now becomes, when do these questions start to get asked about how much am I paying for a stock? And a lot of this exuberance is built into the market. Markets will trend to go higher just because of momentum in the short term. But, we should, be aware that we're probably set up for a decent 5 to 10% correction sometime later this year. I would assume probably sometime between May and October.
Okay. We'll have you here on every week. So we'll be looking with a eagle eye at that, when you think you see the early signs of that correction maybe starting. Can you go back to that chart just for a sec?
Yep. And there's some other things that go along with this I'll get to in just a second, but go ahead.
Okay. So what we see here is pretty classic for an exponential curve, right? Where it doubles in faster and faster times, right? And even though if we hit we've now hit 5,000. So it took roughly the same amount of time to get from 4,000 to 5,000 as it did from 3,000 to 4,000.
Roughly, yeah.
But it would have hit 5,000 a lot sooner if it weren't for the pandemic.
Correct.
Right?
Well, no. We would hit 5,000 in 2022 had it not been for the Russia-Ukraine invasion. Right? So this peak right here, we were almost at 5,000, and then that was where Russia and Ukraine went to war, and then we started selling off.
Okay, all right, sorry, that's 2022. Okay, yeah, so you're right. It was Russia that knocked that down. My greater question here is, yes, bears have to be concerned about the violent drawdowns that you get when the market gets, very overextended, when it has a melt up run. But those drawdowns, as we've talked about in the past, they tend to be, very compressed in time, right? On a relative basis. The bull run is an escalator up. The bear correction is an elevator down. So just looking at this exponential trajectory here, do you sort of look at, as you look at the next 10, 20, 30 years, expect this exponential trend to continue? Yes, it will be punctuated at times by sharp drawdowns, but you expect us to sort of hit each new 1,000 milestone faster and faster and faster?
No. Well, again, you have to assume two things for that to be the case, is that you're going to continue to do $43 trillion in a decade in, financial intervention. So you're talking about a never ending round of quantitative easing. Interest rates are at zero forever. Debts and deficits are continuing to rise sharply. You're just injecting massive liquidity into the market. So the simple answer is that no, you can't maintain that pace. You can't even maintain the pace of that debt issuance like we've done over the last few years. It's just a function that we can't implement that much capital that quickly. So either one of two things will happen. Either you're going to wind up in another secular bear market, which is going to happen, and this is part of the analysis that we do in this article. Let me skip. I got a couple of important charts on sentiment, but the problem is that that valuations run in secular cycles. So once you have finished this secular bull market, which will last probably another 3 to 5 years. We're likely going to go into a long period of zero returns where the market's going to reset itself. And so you'll go through a period like you had in 2000, from 2000 to 2013, 2015, where the market just goes sideways, or you go from the 1960s to 1970 to 1980, where markets just go sideways. So, when you look at this on a non-log scale, which is what you're looking at here, it looks like this exponential growth trend is ramping up. But as we start to move out, that rate of growth will slow just from the function of there's less liquidity that will come into the market over time.
Okay. And I guess a related question is, if you look at a chart of the US debt, that's also growing exponentially. So if we start seeing that debt growth starting to slow or, starting to level out, that obviously would be a sign that commensurate that asset prices are probably going to follow a similar trajectory.
Right. And here, I found the chart I was looking for. So this is, if you look back through history, so this goes back to, basically the, 1900. What you'll notice is that 100% of the stock market gains came from just 4 periods in the market. So, those are secular bull market periods. And we're in one of those secular bull markets right now that started in 2013. So we're going to go through a period where you have multiple contraction, and that's where you have basically flat to negative rates of return over a period of time. And again, so that's going to happen. And so, yes, we have this, the trend of the market will continue to look like this. It'll be this 45-degree slope that'll be punctuated by periods where it goes sideways. And then you'll have the next secular bull market and we'll all be dead and it won't matter because that'll be 30 years from now. But, when we get there, we'll reset valuations. We'll have done a lot of this stuff that needs to be done over time, but that will take a secular period where you have low rates of economic growth.
All right. Hey, just a question on this too. Sorry, I know you're trying to get some other charts, but
That's right.
if you go back to that previous chart, there really only has been one secular bear market since 1980.
Yeah.
And so for a lot of people watching, the only bear market that they remember is, was happening leading up to the great financial crisis, right?
Yeah, 2000 through 2013, 15, yeah.
Yeah, and if you didn't work in tech, at the beginning of the millennium, odds are you probably didn't get walloped that much by the dot-com bust. And we had the housing bubble, kind of raging during that same period. So from a wealth effect standpoint, a lot of people felt somewhat shielded by that because it was, my house is appreciating. But my point is for a lot of people, a lot of investors today, take away the boomers and half of the Xers, they really haven't experienced much of a real secular bear market. And so I guess my question to you is if we do indeed get another one, like you think we will, just describe briefly how you think that's going to feel, because these are long periods. I mean, you look at the previous ones, they were 10 or 20-year periods.
Well, again, you look at that period, and yeah, it looks condensed. It looks like it's small relative to the other ones, but that was basically a 17-year period on a nominal basis, and 13 years on a inflation adjusted basis. So, it's a function where, the majority of investors. So here's a good example of this. In 1960s and 70s, you had a secular bear market where markets had a negative 10% rate of return after inflation. Now, one of the things, let me flip this chart real quick. One thing you'll hear people say is like, well, stocks have never had a negative return over a 10-year period. They've never been negative over a 20-year period. That's wrong. They actually have had negative returns over 10 and 20-year periods once you adjust for inflation. So on a nominal basis, yes, true. But on a real basis, yes, there are periods where you go 10 and 20 years without positive returns. But more importantly, if you spend 10 or 20 years, even if it's a 1% rate of return, and there's a couple of periods of that in U.S. history where you go 20 years with a 1 or 2% rate of return, that's not going to get you to your goal. So, when you're, and people left the market entirely, and this is an important fact, is that after 1974, people didn't come back to the markets until the mid 90s. A lot of people that were invested in 1995, the dot-com bust, they didn't make their first investment until 1990. About 80% of those didn't make their first investment until 1995. By 2010, most of those people were out of the market. So, you go through these periods where you basically wipe people out of the markets. They leave the market entirely. Advisors quit the business because they can't make money, and it's just a terrible environment to be in, dollar wise. And the way that's true is that 80% of Americans have absolutely no money in the bank. They have $500 in savings, and they have little, if any, money actually invested in the financial market. So that we talk about the average 401k balances of 40 grand, whatever. But that just goes to show you what happens when you go through these periods. Most of most of these people online and in YouTube channels and all this that are out there promoting markets and investing and all this, they'll be gone. They won't be around anymore. I've seen them come and go. Like I said, I've been through all of this. I saw in the late 90s, we saw everybody opening up, in every type of trading school that you can imagine. By 2003, they were all gone. We'll see all these YouTube channels and all this that are all finance related and investing. They'll be gone because nobody will want to watch them.
Yeah, and that's kind of where I'm going with this, which is, housing. We've mentioned this in the past. It pretty much increased at the rate of inflation up until the late 90s. And then, the market for mortgage securities got securitized, and then all of a sudden, it became this asset to get gains off of, right? And people started buying homes for appreciation as opposed to just for shelter, right? And so we now as a society have this mentality that a home is an investment that can make you hopefully a lot of money in a relatively short period of time, right? If you buy it at the right price and sell it a few years later in a hot market. And we can have a long discussion about whether, that's really true, and have we bid home prices up to unsustainable levels right now, and does there need to be some big clearing event to get prices down to true values? And I'm sort of trying to make an analogy here with the stock market, where there are lots of periods of time where the stock market doesn't give you YOLO gains, but we've kind of come to expect them because we've just had so many of them over the past couple of decades, largely because of all the intervention that you talked about there, Lance. If we enter into a new secular bear market, is that just one where people aren't glued to their screens wondering what the latest tech stock did this day, and people aren't expecting that, well, of course I'm going to get consistent 8-9% or double-digit percent returns in my portfolio, which a lot of people have gotten really used to over the past 20 years.
Yeah, no, not past 20 years, past 10 years, right? So we've increased, and I've gone through this with you before. From 2009 to present, we increased the average rate of return in stocks by 50% over what we saw in the previous 120 years. So, this is, that's the problem with all these financial interventions. And here's a chart of what you were just saying. Prior to 2000, you had a responsible relationship between the buyer and the lender, and house prices rose relatively at the rate of both wage growth and inflation. And you see that post 2000, this big gap that's emerged between what wages will pay for and what's happening with housing prices. So, again, that's, this is all today's article, exactly to your point, talking about that the Democrats are now pushing this whole idea to make housing even more unaffordable. And this was due to a comment that Elizabeth Warren and 3 other Democrats made to Jerome Powell, saying, hey, you need to cut rates to make housing cut does not make housing affordable. It makes it unaffordable. And this has been the whole problem that we've been going on, because it's all about supply and demand. We have plenty of supply. There's currently 8 months of supply of houses in the markets right now. Normally, when you have 8 months of supply of houses in the markets, you're normally in a recession. So plenty of supply. The problem is that you've run the prices up so much, and you're failing to allow the process to occur to bring those housing prices back down. With that, also, of course, the other big problem is that you got 44% of all home sales were done by home purchases were done by institutions like BlackRock, Blackstone, and others. in 2023 alone. So almost half of almost half of all houses sold last year were bought by institutions and turned into rentals. So that's why you can't get to a place where housing affordable. And I go through solutions in this article about how to make housing affordable. And the problem is that nobody will ever pass these bills, or will any person actually want this to happen? But once you put back on a 20% down payment, no split mortgages, you have to pay PMI mortgage insurance. All of a sudden, houses and prices will come down very quickly, and you have to go through a period of time where you allow that to occur. But once you get that responsible relationship between buyer and lender back into place, houses will return back to growth with inflation.
Hey, if you can, especially for those that are listening on a podcast and can't see the video here, can you just read through your 5 points there? Because look, they talk a lot about housing on this channel. I think both you and I think it's terrible, the levels of unaffordability it's gotten to, and how that's really just taking off a lot of opportunity from the majority of Americans, but certainly from the younger folks that are trying to form households and whatnot. And I agree that housing is like many issues that we face now, which is we are far past beyond the point where we can have a painless solution to get things back in alignment, but we should do it as quickly as we can, because the longer we delay, the more the pain we're going to take in the future anyways. So I'm a huge fan of just having adult-sized discussions around, okay, if we really want to reform, if we really want to clean things up, what's it going to take? So I'd love for folks to hear your ideas.
Sure. Yeah, it's called the terrible, terrible solution because, again, there's only one solution to make housing affordable. And it's not and yes, you could just massively increase supply. That is certainly an option, but that doesn't really solve your problem long term. So to really get it back into place, you got to restrict corporate institutional interest from buying individual homes.
Okay, I'm right there with you on that. Love it.
Right. There's actually a bill that is being floated around Congress. It's not going to go anywhere. It's dead on arrival. But the thesis is that it would require all institutions to sell 10% of their holdings over the next every year for the next 10 years. So it'll never go anywhere, but you have to do that.
Yeah. And sorry to interrupt, because I know we're going to get some comments in the comment section about this, where people who are libertarian-minded, free market-minded are going to say, hey, wait a minute, no, that's not free markets, right? Like, why not just let the market decide who gets to afford what, right? And there's sort of two things about this. Yeah, I mean, I'll give you my thoughts. You can chime in. One is that's sort of the role of government, is to determine where the lines of the playing field are. And I use the example of, like, look, if we didn't have some sort of protective rules and regulations, we would have parts of the country where we would have deforested every tree, or we would have, we'd fish every tuna out of the ocean, and that last tuna would command an amazing price, but then we would have no tuna after that, right? You have to basically say, look, we have to be a steward of our resources to a certain extent, and homes for people to live in, my opinion, is one of those things. Secondly, it's not a fair competition when you put the regular home buyer up against a large corporation that has a far deeper pockets, but also can borrow at much cheaper rates than the average person can. And so it's a total David versus Goliath competition in most cases, and it's hugely disadvantaged. The consumer's at a huge disadvantage, and again, they're trying to buy a place to live in versus a corporation that's just trying to hopefully get a little bit of more incremental growth for their income statement.
Yeah. So look, and I said this is a terrible, terrible solution. This is going to step on people's feet. But in order to fix the problem, now once the problem's fixed, then you can come back and say, okay, now we'll allow institutions back in to buy that. But I mean, you can put a simple rule in place. You can't buy a house unless you're going to live in it, right? But that gets really problematic as well, because there's a lot of individuals that buy homes, they turn them into rentals. That's how they make their income. And so, look, you're going to step on somebody's feet somewhere. But the problem is we have 44% of all your homes being bought by corporations. That removes them from the ability for people to buy them to live in. That's the problem. So, and all I'm talking about is individual homes. I note here, buying individual homes. If they want to go buy multifamilies, go. Corporations can buy all the multifamily apartments they want. I have no problem with that, right? Because that's a whole different bailiwick. But when we're talking about individual homes for people to live in, it's reached the point that it has a negative impact to the average American trying to buy homes, right? Second thing is increase lending standards to require minimum 15% down payment, good credit score, such as also going to increase the stability of banks against another housing crisis. So this would just eliminate all potential like subprime mortgages, adjustable rate mortgages, all that, get all that out of the system. Because once you start requiring, and look, I said 15%, we used to have to be 20 when I was growing up, but even at 15%, homeowners have a much bigger stake in the game. And if they can afford to save 50, the reason this is important is that if you can have the cash flow at home, you get your budget set up at home where you can save a 20% down payment. That's really a two-sided coin. Yes, you've got a good credit score and you've saved up 20% down payment for the home, which that's good for the banks. But it's also good for you because it tells you that, hey, I've got enough free cash flow that I can save up this much money, which means I can afford a home. Because buying a home is not just the purchase price. It's the HOA taxes. It's the maintenance. It's the dues. It's the property taxes. It's the school taxes. It's all this other stuff that goes on with home ownership that puts people in a bad situation. We saw just article after article after statistic after the pandemic. These young millennials went out and they bought homes with their stimmy checks and said, well, nobody told me I had to replace the washer and the dryer, and nobody told me about property taxes. And, all of a sudden the house, they bought these houses and they couldn't afford them because of all the expenses that go along with it. But if you can save up that 15 or 20%, it says, hey, financially, you're in a good position to be able to own a piece of property. Go for it. And again, that solves a whole lot of problems on both sides. Increase your debt to income ratios for home buyers. Again, that resolves all the problems with subprime mortgages, et cetera. Return the mortgage market back to straight fixed rate mortgages. So again, get rid of these adjustable fixed rate splits, all this other stuff that leads to, and the reason that you get rid of those is that allows people to figure out a way to get into a home with much less of a down payment, trying to work the angles in the markets to get into a house they really can't afford. Fannie Mae, FHA has a 3% down mortgage. Those got to go. It's got to be a 15% down mortgage. Yes, mortgage companies are going to suck. They're going to hate this idea because they're not going to make nearly as much money. The banks are going to hate this idea because they're not going to make nearly as much money off of you. They don't mark to market their mortgages anyway. So once you go upside down in the house, they don't care because it really doesn't affect them. This solves all that across the board. Again, terrible solution, but it solves all the problems.
Yep, and let me just grab part of this rail, which is, you're going to have a lot of people say, well, Lance, you're preventing, the lower echelons of society from getting into becoming homeowners because these are the folks that can't scratch this stuff up. And I totally get what you're saying, where you're saying, yeah, I mean, to a certain extent, yes, it sucks to be them. But what we're trying to do here is bring the market back into a healthy balance. And it's allowing people to get into houses who then, once they're in the house, through these extraordinary discounts and measures, that once they're in the house, they can't afford it. Right.
Which is exactly what we saw during 2008. All these people got in on subprime mortgages, blew themselves up because they couldn't afford the house once they got into it. And the bottom line is that home ownership is not for everybody. Home ownership is not a right. It's a privilege. And it means that you've done the work to get to the position to be able to afford a home. And, if you want to aspire to own a home, fix the other things in your life to allow you to get to that point, right? If you have to work multiple jobs, you've got to get better education, whatever it is. I'm just saying is that home ownership is not a right. Every time we want something in this society, it's like, oh, I want that. Oh, that's a right. I should have that right for that. No. You have basic rights. Freedom of religion, freedom of speech, freedom to bear arms, those type of things. Those are your rights. Those are established in the Constitution. Home ownership, healthcare, education, those aren't rights. Those are privileges. And you earn those by doing the work necessary to get there.
Yeah, and I was going to bring up both those examples. If you look at education, you look at healthcare, they're in the exact same state that we are right now in the housing market, right? Where, education now has got up to just ridiculous nosebleed levels. I think it's the single product that has inflated the most over the past couple of decades. And through grade inflation, we make it easier for people who really aren't learning what we want them to learn to get into college. And then the government is happy to lend you as much money as you want to go to the college of your choice to get whatever degree you want. And millions of people who probably would not have been able to get into college are now going, leaving with a piece of paper and saddled with a lifetime of debt and saying, what the hell did I just do to myself? Right. I mean, to your point, it's like college isn't for everybody, but also like it's not serving the long-term interests of these people, right? It espouses to, oh, hey, we're going to put a college degree within your reach. And what it ends up doing is, in way too many cases, is giving people very little to no useful education, and making them basically a debt serf the rest of their lives.
Yeah. And so the last point is require all banks that extend mortgages to hold 25% of the mortgage on their books. That also cleans up the banking side. But here,
and that just basically means the bank can't punt the risk off to somebody else.
Exactly. And right now, the banks can sell off 100% of the mortgage to somebody else, and they just maybe hold servicing rights or something, and that takes all the liability off their books. But let me just read to you this. And look, like I said, I know you're going to get a lot of pushback from these points, but again, this is the whole reason it's called a terrible, terrible solution. Let me just read to you this paragraph. Yes, those are very tough standards to meet, and initially would exclude many from home ownership, but home ownership should be a demanding standard to meet, as the cost of home ownership is high. For the individual, such standards would ensure that home ownership is feasible, and that such ownership, along with the subsequent fees, taxes, maintenance, etc., costs, etc., would still allow for financial stability. For the lenders, it would reduce the liability of another financial crisis to almost zero, as the housing market stability would be inevitable. But most importantly, such strict standards would immediately cause an evaporation of housing demand. With a complete lack of demand, housing prices would fall and reverse the vast appreciation caused by a decade of fiscal and monetary largesse. Yes, it would be a very tough market until those excesses reverse, but such is the consequences of allowing banks and institutions to run amok in the housing market for so long. Now, unfortunately, none of this. Now, look, this is just my article. You can hate on me all day long. None of this is ever going to happen.
So, well, hey, let me just invite folks watching that if you don't like these solutions, right? If you think these are bad ideas, hey,
come up with better ones.
Totally your prerogative, yeah. But then propose your own solutions in the comment section, right? Don't just hate without providing an alternative here, and let's get that adult-sized discussion going. Thanks for going through all that, Lance. I know that there was a tangent we weren't necessarily expecting to take today, but actually I think it's a really valuable one. And I love the fact that you came with specific constructive, proposals for reform, because it's one thing to just sit there and curse the darkness, to do the work and actually light a candle and try to find a better way out. We need a lot more of that. Yeah. Okay, so back to the S&P for a second, because I want to make sure we don't miss it. Do you want to pull up your weekly S&P chart here and just show us where we are? Memory serves, last week we were still pretty far back up into overbought territory. I'm presuming that has continued as we've hit this new record high here.
Yeah. So two interesting points. So this is a little bit different chart than I've kind of doctored this up a little bit for our conversation today. So first of all, yes, you can see by those red boxes at the top. I'm comparing two periods here. One is the current period from November to where we are now, S&P 5,000 at the point of this chart, we're at 55,014 on the index. Comparing this to March through July of last year. And what you'll see is two very similar periods. Both periods very overbought, both top and bottom. That's those pink boxes. The MACD buy signal kind of flipped back and forth at a high level, stayed that way for quite some time. Same thing we're seeing right now with the S&P. Down on the bottom is the relative strength index. It stayed overbought for an extended period of time as everybody was super exuberant. Remember, what was the conversation in June and July of last year? Oh, it's AI. AI is taking over everything. It's NVIDIA. It's all these companies, and it's all about artificial intelligence. This is the same conversation we're having today. And the point is that we are now at that same level where we then subsequently had a 5 to 10% correction of the market. And that was bringing me to these charts a second ago that I wanted to show you. Because in order to kind of look back at that period, we need to talk about, kind of a rational exuberance that we're seeing kind of going on in the markets right now. So what this chart is this chart takes retail and institutional sentiment, right? So bullish or bearish, and, allocation to equity exposure. So it's not just how do I feel about the market, it's what am I actually doing with my money. So it's equity exposure on bullish or bearish side. So when that ratio is above 2.5, which it is now, that has normally been near peaks of markets. It doesn't mean, again, doesn't mean the market's going to have a big major meltdown or anything like that. But it does suggest that you're going to have a period where you had a 5 to a 10% correction. Sometimes it's been more, sometimes it's been 20. But normally, and again, you kind of see back in July of last year, there's that spike that's coming up. And then you had that 10% decline, and we've had this rally again, and we're back above, kind of irrational exuberance. So that just tells us that everybody, basically, if everybody's on one side of the boat, it doesn't take much to tilt the boat in the other direction if people start kind of running in that direction. And that's why you kind of get these corrections when they come. This chart looks at that same sentiment index and divides it by the VIX. So volatility measures fear. And, it's a function of buyers and sellers of put options in the market. So if there's a lot of fear about a correction, volatility tends to go up because people are hedging for that risk. If there's no fear of a correction, then volatility index is very low because nobody thinks there's going to be a crash. Well, right now, volatility is very low. Bullish sentiment is very high. So when you put those two together, you can get an index like this. And it shows us that we're at very, very elevated levels of that index, saying that basically nobody expects a crash and everybody's in the boat. So again, when everybody's bought, Sam Stovall once said from S&P, says, if everybody's bought, then who's left to buy? And that's reasons why you will eventually get some type of correction in the markets. This is our technical composite. So this is a weekly gauge. So look, you get a lot of noise in daily data. So we build this gauge. This is in our newsletter every weekend, and we keep this updated every week along with our fear greed gauges and other stuff that we publish in our weekly newsletter. So if you go to realinvestmentadvice.com and click on the weekly newsletter, you'll see this every week. If you subscribe, you get it for free. I email it to you. But this gauge is at 96.84 as of last Friday. So again, the markets are still going up, so it'll be higher this week. But
so just to underscore it for people that can't see it, which is this reading, which you're saying is now even higher, likely given this week's action,
will be closer to 100.
Yeah, it's
at the
almost
highest
record.
Yeah. It's at one of the highest levels that we've had on record. There was only one other period, that was basically 2018 when we had the 20% correction then. So, but again, that's, this is a weekly composite of relative strength and Williams percent stochastics and everything all put to one index. So it runs from 0 to 100. It's at extremely high level. So again, it's just from a function of sentiment, technical positioning, etc. Everybody's in the boat. Everybody is invested as basically all they can into the markets at this moment. And we're just have pushed that to an extreme. And, again, this has been a very narrow market. In fact, that's where I think we addressed this previously. But when you start looking at, things like performance of different markets and sectors versus themselves, let me say this real quick.
Okay. And while you're pulling it up, I just want to share a related stat I saw the other day, that the S&P's top stocks haven't been this concentrated in over 50 years.
Yeah, that's actually Tuesday's article that's coming out is the importance of concentration. So we'll have that article out this coming Tuesday. But if you take a look at this chart, this is the performance. This goes back to 2014, so this isn't a new thing. This is the NASDAQ versus the S&P versus every other major market. So it's mid cap, small cap, Russell 2000, oil, real estate, international bonds, emerging markets, gold. Everything else is vastly underperformed the NASDAQ stocks. And this is where the concentration point that you're talking about comes from. But if you've been invested in anything other than the S&P, you have vastly underperformed the markets over the last 10 years. And, that has implications for investors as well. So, if you've been hanging on to gold, you haven't made any money. If you've been hanging on to international emerging markets or real estate, hoping it's going to come back, it's just vastly underperformed S&P and NASDAQ. Doesn't mean you didn't make money. I'm not saying that. It's just that it vastly underperformed assets that were driven by a lot of speculation because of zero interest rates, because of massive monetary interventions, quantitative easing, And most of that speculation has occurred in the NASDAQ. And that's what there is a massive deviation between that. If you dig down into the S&P itself, same analysis. Every sector of the S&P has underperformed the S&P, but technology. But because technology is such a large chunk of the S&P weighting, it's basically doing the yeoman's work of pulling the S&P higher while everything else is dragging in the background.
Yeah. I'm just going to share a couple of stats from, I pulled these numbers a few days ago. So these percentages are even worse after the past couple of days. But over the past year, the Magnificent Seven are up like 70 something percent at this point in time. The overall S&P is up 20%.
Yep.
Right? 20+% now. And to your point, pulling that up, making the S&P have had such a great past 12 months has been those Magnificent Seven stocks. As you said, the S&P is market cap weighted. If you look at the equal weight S&P, it's not even up 3% over the past year.
Yeah.
Right. And if you look at the Russell 2000, it's negative.
Exactly. No. Yeah. And large, S&P is up, 25% from, the October 2022 lows or whatever. From those lows. Small caps are still in a bear market. They haven't done anything since October lows of 2022. So, and again, and take a look at earnings. We're ramping up a bunch of the market right now based on better than expected earnings, but the only companies that have earnings growth are the Magnificent Seven. Every other sector and the other 493 stocks in the S&P are actually have reduced earnings. They're missing earnings estimates. They're having
that's a really important chart. And one thing I want to note, just so you can comment on it if you want, is we've been hearing about the Magnificent Seven for a good long while, right? Is hey, these are the stocks that are pulling everything. And people like you who are veterans are saying, hey, weak breadth is actually really bad for markets. But I think the average person kind of doesn't care. Hey, as long as the number's still going up, well, why care, right? Well, now everyone's kind of beginning to talk about the Magnificent Four, right? Where they're like, well, there's some other stocks in the Mag 7 that aren't doing so great. Let's not look at Tesla so much anymore, right? Let's look at the guys that are still pulling the weight. Well, the question happens, well, what happens when it comes to 2 and then 1? What happens when you run out of magnificence? Well, then everything gets pulled down.
Yeah. Well, and that's really kind of the point I'm getting to. So this actual table from Goldman Sachs kind of puts it into a good perspective because, it's one thing to look at a line chart and it says, okay, here's the Magnificent Seven earnings going up and here's everybody else going down. But, if you take a look, the earnings growth in the fourth quarter of 2023 are posting a 14% year-over-year sales gain. The bottom 493 have a negative 110 bips. So they're not growing sales. And that's, again, it's all being pulled up by, so the differential is that the growth of the S&P in terms of net margin and sales growth is all being driven by those top 7 stocks. And they are growing. Even Tesla is still growing earnings and revenue. They're just not growing fast enough, but that's the issue. And this is why, as we're looking at S&P 5000, that's great. It's great. We're at 5,000. Starting on Monday, we're going to be reducing exposure to a lot of stocks and rebalancing risk in a portfolio and raising a little bit of cash. Don't know when we're going to get a correction. So we're not going to do a lot. It's going to be, we'll do a little bit here and a little bit there. But the goal will be, as the markets continue to push higher over the next, month or 2 months or however long it is, we're going to start using more and more of that rally to reduce risk, rebalance the portfolio. Now, we're not getting out of the market. We're not going to cash, and that's not what we're doing. We're just rebalancing risk. So we'll sell big gainers. We'll look at our ones that aren't performing as well. We'll look at why they're not performing. We'll either remove those or add to them if they're good companies and just underperforming. Look at adding to defensive sectors and reducing offensive sectors, and getting set up for what we think will be a fairly decent correction sometime over the next several months.
Okay, so you are now starting to put words into action in terms of, hey, you see everybody on the same side of the boat. You see the rubber band as stretched as far as it's ever been stretched on the overbought side. And so you're starting to say, all right, look, we're going to start taking some chips off the table. We're not getting we're not leaving the table yet,
Yeah.
but we're starting to bring some of our chips in. All right. Well, we'll, as always, at the end of this discussion, Lance, we'll get into your specific trades that you made this week, and maybe, you know, if there's anything else you want to say about the trades you're planning on making.
We haven't done any this week, so
Oh, well, all
right
right.
now we're running the market, but yeah.
Okay. But maybe we'll talk at that point about, you know, which positions you're thinking you're going to start selling next week. I've got too much to get through, so I'm already sort of jettisoning some of the questions I have for you here, but I want to make sure we get to a couple of key things. One of which was last week we mentioned your piece on retirement savers piling into stocks. Is that a good idea? I'm going to presume it's probably an even, you like that idea even less, given how stretched the rubber band is right now.
Right.
Before we get there, just a couple of quick updates for folks. One, you briefly mentioned the weekly RIA newsletter that you guys publish. You showed some of the charts that are in every newsletter. I just wanted to thank you and give your team props for allowing us to start including your newsletter in the email that I send out to everybody on Saturdays when I send them the link to this video. As most folks know, I write up my detailed takeaways from the long form interviews I do on this channel. Those Adams notes, my version of Cliff Notes, those go out to the premium subscribers of our Substack. I don't have the chance to write those for these discussions with Lance, just because there's not enough time between when Lance and I actually film this and the editing's done versus when the emails have to go out on Saturday morning. So to try to give some additional value to folks on the day that we launch one of these videos, I asked Lance and his team if they wouldn't mind if I included their newsletter at the bottom of the email that I send out. They said, yes, we did it last week. We got a lot of great feedback on it. Lance, folks really enjoyed it. So just wanted again to thank you and your team for letting us do that.
Yeah, and this weekend's going to be good too, because we're talking about market breadth. So it kind of goes right along this conversation.
Great. Look, I am so confident, Lance, that there is no topic that I can't bring up that you are not writing an article on it.
I try to read your mind. I try to, make sure I'm ahead of the curve most of the time.
Well, that's where it's one of the advantages to have a very simple, empty mind is I think I'm an easy book for you to read. All right, a couple quick other just updates for folks. One, it's been a busy couple of weeks in a really fun way. And one of the things that happened over the past week and a half is I was invited by the folks at Zero Hedge. Zero Hedge has started these debates. I think they've only done 2 of them so far, but they're massive. I think their last debate was watched by over 5 million people. They are going to do their first economic-related debate next week. It's going to be Tuesday night, 7 p.m. Eastern, 4 p.m. Pacific. It's going to be about the fate of the U.S. dollar, and they invited me to moderate it. And it's a great panel. On the pro side for the dollar is going to be Brent Johnson of Dollar Milkshake fame and Michael Every of Rabobank. On the con side is going to be Jim Rickards and Bob Murphy from the Mises Institute. So folks, that should be really interesting. I'll be hopping a plane in a couple of days. We're going to actually shoot that live in a studio. Should be really fun and well produced, but keep your eyes out for that. Secondly, I was talking with you, Lance, before we turned the camera on here. I had my first invitation to appear on like a major mainstream financial TV show. Charles Payne invited me briefly on his program there on Fox Business. Really hard for a guy who's used to having an hour or more to fully flesh out his thoughts, to have to cram into like a 2-minute segment and just talking pithy little sound bites. You do it all the time. So you're a master at it, but it was definitely a different experience for me. But Charles was very, very kind. I wanted to go through on this discussion today with you on the massive amount of work I put in to the tome of information I was going to try to share in those 2 minutes, which of course I got to share like 1% of it. Right. But a lot of great points here. But this is one of the things I'm going to punt for next week. But I will give you the punchline or the theme, which was, hey, if this doesn't feel like a strong economy to you, we're being told everywhere, hey, it's Goldilocks, massive GDP growth, inflation's done, job market super strong. That is just not matching many people's daily lived experience. And I think people are really beginning to feel kind of gaslit by this. So I go into kind of the data that says, hey, if you're feeling like they're telling you the sun's shining, but you're feeling like it's raining. You're not crazy, and you're certainly not alone. So if we've got time next week, we'll dig into that. But if we can, Lance, let's pull up your retirement piece there, because I think that's very relevant to most of the people who are watching today. And it sounds like, and I don't want to put words in your mouth, but it sounds like you're saying, if you've got to really count on your money for retirement, yeah, maybe the gains that equity investors are enjoying right now, especially in those Mag 7 stocks, are looking really tasty. But this may not be the time to jump in the pool, because this may be, getting closer to the point where things start to reverse.
Well, yeah, okay. So I got to be real careful with you because you're always super bearish. You know,
All right. Well, stop growing as fast. I don't know.
No. Well, my point is that, and again, we'll get into this, is that this is about longer term issues, right? So, and this is, there's a big difference. If you're 30 years old, like I get emails from your viewers that are 25, 28, 30 years old. And they're like, Adam's really got me worried about A, B, or C. I'm like, dude, you're 28 years old. Take your money, put it in an S&P index, dollar cost average that every single month with 30% of your income, and call me in 30 years when you retire, and I'll manage your money for you. Because you don't need to worry about this stuff. If you've got 30 years ahead of you, don't worry about any of this stuff. Put your head down, do your job, earn a bunch of money, and save 30 to 40% of your income. You will have nothing to worry about the rest of your life.
And just to be clear, totally agree with that. Folks at that age, exercise your earnings and savings muscles. The investing stuff will take care of itself. I would say, look, largely follow what Lance says. Have some portion of your money that you're putting away in investing that maybe has some risk managed protection against it, just in case you don't get wiped out if you start at the wrong period of time. But Lance is very right, which is, if you've got that much trajectory, the market will take care of you over that long of a period. Really focus on what you can put in. So we're not philosophically divided here, Lance.
Yeah, but when it comes to people that are in their 45, they're 45, they're 48, they're 50, and they've got some money saved up and they're going into retirement, that's a different story. Because if we do, and we will, have another 30 or 40 or 50% correction at some point, and when that happens, it could be 5 years from now, it could be 10 years from now, it could be 15 years from now. Predicting those type of things are very, very difficult. But at some point, we're going to have a meaningful correction of some sort.
And sorry to interrupt again, but I just want to underscore, more than 2/3 of this viewing audience is 45 and older. So, that's one of the reasons why we focus so much on this.
Right. And so this article is for those individuals. So Bloomberg recently took a poll. And what they came up with, they said, what are you going to do to hedge for inflation, for future retirees? And they said, well, 46% of them are putting into stocks, 29% some other way, 19% said they're not doing anything, 6% said they're putting it into gold. Makes complete sense, because stocks have been a better hedge for inflation than gold or anything else at this point. So understand that after the last 15 years, when you're throwing out 12, 13% rates of return every single year, makes complete sense, while they've all been trained now to just stick money into the S&P. We'll get into that in a second. They also believe that stock prices and home prices will go up over time. So they'll appreciate. 33% of them thought stocks and real estate will appreciate more than bonds or anything else. And they're, again, based on recent history, they're absolutely right. And this is the point I was making to you earlier. So this is the market over a very, very long period of time, from 1928 to 2023. This is as end of year 2023. The market averaged 8.45% a year. 1928 to the dot-com bubble, strip out the whole secular bear market from 2000 to present, 9.25%. So basically 8% from 73 to 2023. So basically anywhere that, however you want to break that time frame up, the market returned about 8% on average over time. Now that's not, when you say that is 6% appreciation, 4% dividends on average. Subtract out 2% inflation, you get 8%. That's how you get to that 8% number. Since 2009, we've tacked on an additional 4% above that. So 50% increase over the rate of return from 1928 to present has been ramped up. And that's all that monetary stimulus, QE, zero interest rates, all that. So this is why everybody in the market today is like, man, I just put my money in the stock market. It just goes up. It's a no-lose situation. I'm going to make 15% a year because that's what they've seen for the last years. And this was also, ironically, the very same thing we saw with people saying in 1999 as well, because from 1990 to 1999, the market was cranking out 15% a year. So why not be in stocks, right? And then it ends. And that's the whole point of this, is that when you take, and so, you know, there's a reason that investors are doing this, is because they're undersaved for retirement. CNBC did a survey and they said, how much do you think you need for retirement? People in their 20s thought 1.3 million. People in their 50s thought 1.6 million. If they were over 70, they needed about $1 million. So on average, for all ages, they thought they needed about 1.3 million. The problem is that the vast majority of people have absolutely hardly anything saved for retirement. And that's by virtually all income groups. And so, you know, when you start talking about $500,000 or more, only 9% of the population has got there. If you need 1.3 million, you're way far away. So this is why individuals are going, I need more money into stocks to try to make up for my shortfall in savings. I'm not doing my job on my savings side, but I'm hoping the stock market's going to make up the difference. And so we're taking on an exceptional amount of risk. And again, that increase in the stock market is directly correlated to the massive amount of stimulus that we put into the market. So again, my question to you earlier is in order to sustain this, in order to continue to have that exponential growth, you've got to continue to have this type of stimulative spending. I'm not saying they can't do it, but it seems that that's going to be a much harder challenge going forward. And when that stimulative spending runs out, you're going to wind up, and this is that chart I was showing you earlier, you're going to wind back up into a secular bear market period where, again, what is a secular bear market? That doesn't mean you get no returns. It means that you have a 30 or 40% downturn. You have a rally of 30, 40, 50%. Then you have another 20% downturn, and you look back over a decade and your return is zero because there's been some great rallies to trade off of, but there's been big bear markets during that period that wiped out all of your returns.
Right. And so just to underscore one important part there, which is that's where the passive approach really falls apart.
Correct.
Right. Passive approaches work great in those secular bull markets. Everybody's used to they've been trained that passive is the way to go now. So if we do indeed enter a secular bear market, that's where the passive. So basically, if we do enter a secular bear market, you really want to think about taking a much more active approach, because to your point, you can make money in those environments, but generally not using a passive playbook.
That's right. And look, this is why passive investing has become such a big thing over the last decade. Passive investing now has more assets than active management, and it absolutely should. You know, you've had 14 years of just this market just goes higher, every single year. So, that's why we've gotten here. But again, and it's interesting because you talk about, and this is my article coming up on Tuesday, kind of reminiscing about the Nifty 50. A lot of the things about market concentration, about AI is the next big thing, and it's just going to take over everything. Those are the same conversations we had with the dot-com bubble. That was the same conversation we had with the Nifty 50. The Nifty 50 back in the 70s was like, these are the companies generating all the money. Just invest in those companies. They're the future. And then you had the 1973-74 bear market that just put a nail right through that whole thesis. So, we're seeing exactly the same psychology that we see at every peak previous period where people thought, oh, this time is different. AI, computers, dot-com, whatever. There's always a new revolution, space race back in the 60s, 70s. There's always a new revolution of something going on. And we all believe that this is going to be the never ending, story of a bull market, but it will end. And now and don't get me wrong. I'm not saying that we're about to have a big bear market, that next year this is going to happen and you need to be all in cash. I'm not saying that at all. This market can continue to grind higher for a lot longer than you think. Nobody knows what will trigger a bear market. What we do know historically is that one will occur, but it could be 10 years from now. We're basically about 12 years into this secular bull market period. These periods tend to last 18 to 20 years. So there's potentially a long runway left in this market. Eventually, we'll go through a period that rectifies some of these issues, but it could be a very long time. So you don't want to sit there in cash trying to wait it out, waiting for the opportunity. Don't do that.
All right. So to the 45 plus audience that's watching this right now and has heard you say, hey, this may not be the time to just go whole hog into stocks to try to make up for any shortfalls you have in your savings goals. And you're also saying, hey, just don't run to cash. Yeah. What would you say to them?
Well, you invest prudently, right? You don't have your whole portfolio invested in NVIDIA. As an example, you build a well-allocated portfolio, you manage the risk of the portfolio, but more importantly, that's just a very small piece. All your portfolio is supposed to do is just try to adjust your portfolio at the rate of inflation, which is 3% right now. So your goal should be to create 3% out of your portfolio, and then everything else in terms of growth of savings comes from what you're saving from your business. So if you build a portfolio to generate a 3% or 4% rate of return over time, you can do that very safely without taking on an exorbitant amount of risk. The people that are going to lose 30, 40, 50% of their portfolio whenever this event occurs, whether it's next year or 10 years from now, they're going to lose that because they have money aggressively invested in overpriced, overvalued equities. And so if you look in your portfolio and your portfolio is full of stocks that are trading at 30 times price to sales, you're going to have a problem when this occurs. You build a portfolio to generate 3-4% a year and you're saving 30 to 40% of your income, you will get through retirement. You will be in retirement safely, and you'll be able to live through that retirement with no problem at all, regardless of what the market does.
Yeah. All right. Well, look, I know I'm sort of talking our usual book here, but for most people for whom that logic makes a lot of sense, but are asking themselves, okay, but how do I do that? Right. This is why you want to find a good professional financial advisor who can.
Now, look, let me clarify. Look, my job is not to grow. My job is to try to meet hurdle rates. So in other words, you do a financial plan and they say, okay, you need 5% to reach your goal. My job is to build a portfolio that will do that, maybe even exceed that would be nice. And so we try to exceed those goals. So if I can, in 2021 or whatever, the market was up 22, we were up like 18. That's great. I can lock in, long-time returns. 2022, the market's down 20. We're down about 8, 9. That's great. We can lock in returns that way. But again, if you're banking on doing, beating the market every year, that's where you get yourself into trouble. You build a portfolio to generate a set rate of return. But if you can do better than that, that's awesome, right? The trick is not to lose 50% of your money.
Right. And as we've talked about many times, the overall objective is to get a good sense at the start in terms of what you need to meet your goals and not get distracted by what the market's doing in any particular year, right? Because as you've said many times, people oftentimes will self-sabotage themselves the most if they only need 5%, but then they see their neighbor getting 15% in some, darling stock at the moment. And so they figure, oh, I got to chase that. And then that stock corrects and then they're worse off than they were if they had just stuck to their knitting, right?
That's correct. Yeah, that's right. I mean, and look, it's the media has done a fantastic job of converting the entire market into a giant casino, right? And so that's the way we treat it. I mean, as individuals, we all just treat the market as a big casino. It's red lights and green lights every day and bells and whistles going off. And, somebody's getting, the bells ringing over here for some guy that just, bought a stock that went up 50% overnight or whatever. And so we got to go do that. It's just, we've lost the whole point of why we invest, which is to buy assets that are undervalued, have them appreciate over time and sell them at a higher price. We've lost that whole analysis about investing, but that's the problem that we'll have to deal with at some point in the future. And that will what separates the winners from the losers. And look, there's great examples of this throughout history. If you were 45 in 1999, by the time you had any rate of return, you're now 58. So if you weren't saved for retirement at 45, you're now 58 with no more money than you had when you were 45, and you're facing retirement. But that's what a secondary bear market period will do to you. Except the one commodity you can't get more of, and that's time. And
that's time.
I'll forget is that we can always make up losses, right? Making up losses is easy. We can always get back to even. That's not making money. But the one thing we don't get back, if we spend 5 years or 10 years getting back to even, that's great. We don't get the 5 to 10 years back. Right? That's the one commodity that's more precious than anything else we have in investing is time.
And maybe that's really the way to be looking at your relationship with your financial advisor, or if you're looking at multiple different advisors and trying to figure out who to work with, is saying, okay, which guy is actually going to save me the most time versus make me the most money.
Correct.
All right, so I want to. There's a point I want to get to, but I think I'm going to get to it using the bridge of the chart you showed earlier that showed how much people believe they need for retirement. And I think those expectations, sadly, aren't too far off, and probably maybe even on the low side for a certain amount of people. You know, need $1 million or more if you really want to retire, meaning I'm going to live for 20, 30 plus years without any income, right? If I've got to live off my savings. And then you contrast that with just the paltry amount that the majority of people have saved for retirement, right? We've talked about this a fair amount. So, you know, this actually is a big reason why I founded Thoughtful Money. You know, I think I've shared in the past that my folks got divorced when I was real young. My mother got custody. She did not have much of a financial background at all, and I saw her, you know, struggle growing up in the house that she ran. And you know, in retrospect, now that I know a lot more about finances, you know, saw her make a lot of bad mistakes, and saw how stressful money was in her life, and saw how she got to retirement age without any retirement savings, and how that's not a fate I would wish on anybody if they could avoid it. So, you know, a big part of what we're trying to do on this channel is to help educate people how to be more successful wealth builders so that they can avoid fates like that. But, you know, when you look at those stats, Lance, like that's kind of where I really get worried about society, which is that we're just unprepared and underinvested for the future that we're heading into. I mean, to me, it just at its core, it just seems like a math problem. And I wonder, because you spend your days with people, you know, trying to save for their futures. How much does that concern you from a societal standpoint?
A lot. You know, because, you know, we don't teach, you know, this goes back to all the conversations we've had previously, right? We don't teach the fundamental basics of building wealth. And, you know, look, I even, you know, it's great that we have this conversation every week, but it's not really helpful in that term. I mean, we should almost be doing a weekly show on this is how you invest in real estate. Here's what you need to be looking for. This is how you invest in.
You're gonna kill us, because as you and I have talked about, we want to create that type of video, and everyone's going to say, yes, do that next week, right? So
I know, yeah, this isn't going to happen next week, but I'm just saying is that that's the channel that we should build ultimately, which is a class every week about how to invest, how to manage your money, how to budget, how to create, you know, better financial incentives for yourself. You know, things that you can do. You know, we don't teach those things, and, you know, people wonder why they don't have any money. And look, I mean, social media is a huge culprit of all this. If you really want to save money, put social media down, because, you know, A, you're wasting time on social media you could be using to make money with, but also B, you know, you're constantly being inundated with buy this, buy this, buy this, buy this. And it's easy. I just, you know, buy it. It hits my credit card or my debit card, whatever. And, you know, I really don't see the money go out and stuff shows up at my door. It's fantastic. But we have so much leakage within our financial situation that we can't save any money. And so, you know, it's always interesting when I tell people, it's like, you need to save 30% of your income. It's like, well, I can't do it. Well, have you tried? Well, you can't do it because you're not willing to sacrifice having a $2,000 iPhone and having a laptop and having, you know, internet and having, you know, whatever, you know, all these things that we think we need to have. Do you really? Right? Or there are other alternatives? You know, what's keeping you from saving money? And it's always the differentiation between my wants and my needs. You know, what do you need to live versus what do you want to have? And the wants need to go in a bucket that says, when I can afford those, after I've saved 30% of my money, I'll go buy that. and I'll
Right.
pay
And we
cash
need to
for
be
it.
honest about what truly is a need versus a want. There's a
Right.
lot of things that we feel we need, but they're not really
Yeah.
essential. Yeah.
Yeah. Do you need an iPhone, or would a $20 flip phone work just as well? Right. I mean, it's not cool, right? Your friends are gonna ostracize you, but if they're gonna ostracize you for a $20 phone, are they really your friends? And the most important lesson I try to teach my kids every time I see them, right? And when they're with their friends, I always ask them, I say, is that the person that's going to make you a better person in 5 years? And they ditch friends on a pretty regular basis because of that.
Hmm.
Because the people you surround yourself with today is the person you're going to be 5 years from now. And if you surround yourself with a bunch of broke ass kids that are, people that have all their, they spend all their money, they're dead up to their eyeballs, and they're trying to keep up with the Joneses, that's exactly where you're going to be in 5 years.
Well, so this is taking the conversation where I wanted to take it, which is behavior is destiny, right? The choices I make today determine where I'm going to be tomorrow. And I'm taking this somewhere, but let me just ask you this. So, when you look at that math that you put up there, right, that people have, 5% or less of what they think they're going to need to retire, even those, that are in the 55 to 64 cohort that are, just about to hit retirement age. The gap between what they really need versus what they have is still massive. What's that going to look like? That's really what I want to kind of get your opinion on here, which is, we've had this society where, retirement, like being able to stop working, it's a relatively new construct for the masses, right? I mean, yeah, if you were Vanderbilt or Rockefeller, sure. But, 100 years ago, there weren't that many people talking about retirement. I don't even think the word retirement was really a word back then.
But we also died at 65 to 72. So.
Yeah, exactly. We didn't have to live as long, right? Their savings
Right.
didn't have to do as much heavy lifting, right?
Maybe that was a blessing.
Well, we'll talk about that more if you want. But so we've had this sort of halcyon couple of generations where folks could stop working, and then Social Security contributed as well. And so we had a lot of people who could sell their house, buy a condo in Florida, and play shuffleboard for a couple of decades, right? Yeah. We may be entering a period where the number of people, or the percentage of people who can do that, becomes substantially less, maybe even drastically less than what it was. What does that look like in society?
Well, I mean, it's got two problems with it. One is that what's supposed to happen in society is that, okay, let's just take me as an example, right? So I'm almost 60. I run a successful business along with my partners. Very blessed, right? I this is the fourth business I built. Very, very blessed to have had the opportunities to create and use capitalism to my advantage. Now, in theory, I should be retiring at 65, and then I pass that opportunity to somebody else in my organization. I'm not talking about giving it to my kids. I'm not saying that. But just say I'm working for a company and the CEO retires. That job should then be opened up to whatever vice president's in line. He moves up, and then the guy that's below the vice president, he moves up into that spot. And there's this migration of jobs up as the older guard retire. Well, the problem is that because we're all now living longer, it's basically robbing a lot of our youth of opportunity because they're not able to move up in those jobs because that old bastard won't retire. He's just going to stay up there forever and he won't quit. And so since he's going to keep working longer and longer and longer, there is this problem that we're kind of robbing our youth of those opportunities to advance in their workplace until much later in life, right? So that means that they're not creating the income growth. So when I was growing up, you kind of hit peak maximum income growth in your mid 40s. We're now starting to see that move up into the 50s before people are hitting their maximum income growth. So that's kind of what's happening in society because of this aging of our environment. The other problem is, of course, is the immigration issues, et cetera, that's robbing our youth of jobs as well. And so we're really impacting the younger generation negatively on multiple fronts because of with monetary policy and all these type of things that have elevated cost of maintaining what is considered to be a normal life. And then also this aging demographic issue, which is keeping them from being able to have the opportunities they need to increase their incomes.
You're perfectly teeing up the rant for this week, just FYI, just so you know. All right, so let me so my underlying concern here, which it sounds like you share, is that we are setting ourselves up for, I think, kind of a variety of societal what do you want to call them? Ills, undesirable ramifications from this. It's going to be piling up of seniors that just sadly can't afford to stop working, right? And of course, as they have health issues and whatnot, you're just gonna have a lot of people that begin to fall into the I can't not work, but I also can't work. Like I'm just not healthy enough to do it, right? And that's going to create a big societal issue to be dealt with. That I just don't have a lot of faith is going to be dealt with gracefully in ways that pleases many of the participants. So anyways, I want to use that as an analogy now for what's happening at the national level. So we've had public statements from Fed Chair Jerome Powell and U.S. Treasury Secretary Janet Yellen that have basically said, hey, you know what? Like the country is not on a sustainable fiscal path. And we need to get our fiscal house in order, right? So Powell specifically said that the U.S. is on an unsustainable fiscal path amid record high national debt. It's, quote, past time to address our national debt. And then Yellen said it's crucial that the United States get its fiscal house in order. It's critically important that the U.S. be on a fiscally sustainable path. So what's so interesting is we have these people that are running the ship of state that we're looking to be, running the best policies, and they're kind of pointing fingers at each other saying, hey, I'm doing my job right, but you guys need to get your act in gear. And the fact that
it's not the Fed and it's not the Treasury, it's Congress. Congress.
Well, it's Congress and the administration.
I mean, just take a look at this recent border bill, right? $118 billion and $20 billion went to the border. I mean, stop spending money on just everything.
So I agree with you, and we can rant on that. And I want to mention this headline by Nomura, which says that the administration is, quote, all gas, no brakes on economic reflation. It's running it hot into the election, which it says is wrecking Powell's plan. Which is one reason why I can understand that Powell is kind of angry here. But my point is whether we like it or not, it is happening, right? Like we've got many of the players on the chessboard at the highest levels saying, fiscally at least, we're running in a direction that is running things off the rails, which, I'm sort of tying it to what we just talked about demographically, which is saying, hey, we've got seniors that are running headlong into a retirement that they clearly don't seem to be able to afford. Are we doing the same thing nationally here?
Yeah, absolutely. And look, this isn't a Republican Democrat issue. So, don't take away from this conversation that, the Democrats are the ones spending all the money and the Republicans want to cut. No, they all want to spend money, and they may talk a good game. But when I did political talk for over almost a decade, I tell you, I interviewed all these guys, and they're all like, "Oh yeah, we're going to cut spending as soon as they get elected. That's spending off the rails." So don't fall into any of this game about, oh, we're going to cut spending and we're going to do this on the budget, because if they did, if any of them actually had the cojones to do that, we would have a budget. We wouldn't be using continuing resolutions, and we could cut spending. But nobody wants that to occur, because again, look, Biden just forgave billions of dollars worth of student loan debt. Sounds great, right? Somebody's got to pay for it, though. And again, you may agree with these. And look, this isn't political. You may agree with the policies. You may not agree with the policies.
Well, it's political. It's just not partisan. I agree with you.
Right. I'm just saying it's, I'm not picking a side. I'm just saying, look, they're all not helping. And, all the talk that they have about, oh, we're going to do this and we're going to do this, it's all not real, because at the end of the day, they can, it's a problem when you can't pass a bill. Like I want to fund, just let's pick the border, right? I want to put $50 billion towards securing the border, right? You have one bill, one item, and that's it. No, we got
to pack everything into it. Yeah.
Yeah. You got to have all this other stuff to just even get it passed, because that's all the payoffs, right? These bills, the reason they're structured that way is because in order to get the votes, I've got to go to Adam and say, Adam, I need you to vote for this bill. Well, Adam goes, well, I don't support it. secure border. But Adam, what would it take for you to support the bill to secure the border? Oh, well, I'll tell you what, if you give me $20 billion for my pet project in California, then I'll vote for it. That's how it happens, right? This is why these bills are that way. We can't just have an honest conversation and say, we're going to pass a bill for this need. And you think about this, right? I mean, $118 billion. We could solve homelessness for $4 billion. We could solve healthcare for Americans for probably 20 to 30 billion. I mean, the amount of money that you're spending in this one bill, and I forget about, securing the border, because Texas is doing the job itself. So let them do their job, give them a little help.
Right. Well, and sorry, also too, but this proposed bill too, I mean, there's still massive quotas of illegal immigrants that are allowed. It doesn't really solve the problem. Yeah.
It doesn't secure the border at all. That's irrelevant. But my point is that out of 118 billion, 20 billion of it is directed towards the United States, right? The rest of it is going to foreign countries. Now, again, I'm not saying we eliminate all foreign spending, et cetera. I'm not saying that. My point though is that we could solve so many of these problems if we would focus on domestic policy first, international policy second. But we always have it backwards. And again, this is why, but we've got such a divided Congress. And again, it's all this talk, but all this debt is going to lead to the following: slower economic growth, wider gaps in economic prosperity between the rich and the poor, lower rates of inflation to deflation over time, lower interest rates, which aren't good. The lower your interest rates are, the less economic growth you have over time. So all this leads to a worse outcome for you. You may agree with these policies, and that's fine. I don't care if you agree or disagree with what's going on in Washington. All I'm telling you is the debt and the deficit is going to make your life worse. None of this is going to provide you with better economic prosperity over the long term.
Thank you. Because that's where I was taking this, which was, we talked last week. I asked you the question, given that fiscal spending is now, maximum fiscal spending is now business as usual, will anyone have the political appetite to rein that back in? I think you and I both sort of concluded, no, probably not, right? So
because you'll have it
right. So like it or not, this is where things are headed. So, we can either ignore it, right, and just, have a false hope that someone's going to come resolve it, or we can prepare for it, right? We can say, if this is where the puck is headed nationally, what can I do to make sure that I'm not collateral damage for that? You just lined out where you think this is really headed, right? Slower economic growth, probably likely deflation over time, right? Just fewer things are going to get done. Fewer things are going to get passed. Probably a lot of benefits that were promised in the future aren't going to materialize, right? Whatever that list is, right? So once we know that, maybe we don't like it, but we can say, okay, well, I can start planning around that, right? And that's the value of trying to see the future more clearly, right? So anyways, that's where I wanted to clarify for folks.
No, and that's a great point, because if your future, if you're approaching retirement, you're like, okay, look, if I can get, I've had this chart up the whole time around what people expect to need for retirement versus what they currently have. So when I bring this up, I invariably always get this email. This email will come in. I'll have this email tomorrow. But Lance, because I'll have X dollars a month on Social Security and Medicare, so I don't need that much money saved up because I'll have that. What if it's not there for some reason? I'm not saying it's not going to be there, right? The worst thing that we could see happen in this country is that Social Security actually goes bankrupt. I mean, there will be millions of people living on the street, because there is a vast number of Americans that depend on Social Security for 50% of their retirement income, and a lot of them that depended on it for up to 90% of their income. So the destruction of Social Security has massive implications. But the point is just, what if it's not there? Why prepare your whole retirement banking on a government handout? Yes, I know you paid into it and you think you deserve it. I'm not disagreeing with that. I'm just saying, what if it's not there? I mean, we're giving it to illegals right now. So that's more money out of the kitty that's not going to be there for you down the road. So why would it not be better to plan for the worst and hope for the best? And how do I plan for the worst? Make sure that you're saving enough to have enough saved up for retirement that it can generate its own income stream. Buy assets that can generate an income stream. Buy things that can protect assets over time, provide tax-free withdrawals, do those type of things, provide you some ability to navigate better, guarantee you an income in life, like annuities. I can put money into a guaranteed income annuity and have a guaranteed, I can secure for retirement. But why bank your whole retirement on a handout from the government? What if it's not there? See, that's the risk. And look, if it is there, now look, and I'm not saying it's not going to be there. So don't go run off and say, well, Social Security's going bankrupt. I'm not saying that. What I'm saying is, why bank on it just in case? Right. If I prepare for my retirement and I've got my whole retirement secured and I get Social Security, bonus, right? As my son would say, bet, because that's just extra money I get to spend now. That's awesome. And if something happens down the road, I don't have to worry about taking care of myself and my family.
All right. Well, hopefully we've really beaten this horse to a bloody pulp at this point in time. But again, folks, this is a huge part of why Lance and I do this on a weekly basis, is we want to try to make folks as aware as possible as to what the reality is on the ground so that you can make more informed decisions. All right, Lance, I want to get to our rant and then we'll wrap things up. Real quick though, you mentioned, it sounds like you didn't make any trades over the past week, but you're planning on making trades this week. Any other additional detail about the type of plans? Like, do you have a sense of which securities you want to sell, or any parts of your strategy you want to do?
Yeah, so we own some of the Magnificent Seven as a good example, right? So we own NVIDIA and AMD and Microsoft and Google in our portfolio. They've had huge runs. So now, and the way we run our portfolios, everything has a weight. So we have a maximum weight and a minimum weight. So a lot of these companies and other good companies had a huge run, as AbbVie, healthcare, in the healthcare space. These stocks have had massive runs, and they are now have a bigger weighting than their target. So we'll reduce those back to their target weight, right, and keep that cash. We have some other positions that are really good quality companies that have not participated in this rally, but they throw off a good dividend. And if we get a rotation from risk on to risk off, most likely we'll see a rotation to some more of those defensive type names. So we'll look for positions that are underweight their target and bring those up to weight. So again, it's not a massive selling campaign. We're not just liquidating everything going to cash. But we're starting to reduce risk by rebalancing. And then if we start getting sell indicators and those type of things that occur, then we can reduce equity exposure more. We can short against the portfolio, what we call short against the box. Some other things that we're doing, like in our in some of our high net worth models, is we're writing collars around option collars around certain stocks as well, because there's enough of a skew now that's occurred within the options market that we can write profitable collars. In other words, it doesn't cost us any money. We actually make money by writing a collar, and we can lock in the price. So, there's a lot of things that we can do to start kind of preparing for an eventual 5 to 10% correction, so that we don't have to wait for the correction to start to then take action.
All right, great. And just a reminder to folks, Lance is on this channel every week. So as he makes any changes to that strategy he just laid out, he'll share them here with us, so you'll be kept informed in real time. All right. Well, look, getting to the rant, there's actually sort of two topics I wanted to talk about, both of which we could spend a long time on. The first one I just want to spend just a minute on, because it's notable and it's related to what we talked about last week when we talked about how people were really beginning to lose faith in the mainstream media and turning to alternative sources, and sort of acknowledging some of the responsibility we have, Lance, to create valuable content for viewers. I just want to note, because it's material to that discussion, the interview that Tucker Carlson just released last night with Vladimir Putin. And look, I don't want to get into the potential hornet's nest of who's right and who's wrong and all that stuff. I just want to say it was a long form, serious discussion of a hugely important issue. Right. And we got to hear at length the detailed thinking of one of the most important players in one of the most important issues that the world is dealing with right now. And we didn't have that information beforehand. And I'm of the opinion that more information is generally always better. And the populace can then, evaluate all the different information that's being put out by all the different sources and compare them against each other and hopefully by doing that, come up with a better sense of what the truth is. And so I thought that was a material milestone in the type of media that we're in, which is this thoughtful, long form discussion of, not trying to force a complex topic into just a couple of sound bites, but to really let, in this case, one of the players put their full thinking on the table. I would love to see something very similar replicated where perhaps a Russian journalist sits down and interviews President Biden, right? Or another journalist interviews Zelensky. And we can all kind of crawl into their brains and hear what every player is thinking, and then decide for ourselves, where the information matches up and where it doesn't, and do additional research. But I thought that was
ironically, that's called journalism.
Yeah, it's called journalism. And so I thought that was an important and I think positive step forward for journalism, right? Like
I'm surprised he's still alive, though, personally.
For content. Yeah, well, I mean, and we'll see. And look, as you can see, I'm trying to take care not to say endorse any one particular side or any particular person or party there.
But no, look, your point is, look, this is the problem that you and I have doing even this commentary on Fridays, right? I have personal biases like everybody does, right? So, I have personal biases towards certain things, and there are certain facts that I know are true and factual, but there's always somebody out there willing to argue that, right? And so, because people have different biases and different feelings and thoughts, and whether they have the right information or they have misinformation is basically generally where you garner it from the internet. So, the whole purpose of having a conversation is to present, a side of an argument, and for you to either agree with it or disagree with it, but then go, okay. And this is what we talk a lot about investing is like, don't just go listen to all the bearish people and don't go listen to just the bullish people. Listen to both sides, get both sides of the argument so that you can make a better decision about where to invest your capital. The problem is that we're so personally invested now in defending our narrative, whatever our personal narrative is, right? Whether it's immigration or gender or whatever it is today, right? Whatever your, climate change, whatever our personal narrative is and whatever we want to believe, we are so defensive of that position that we won't even listen to somebody else's opinion, regardless of what it is. We won't even consider it because I'm so vested in defending my position, and I can't be proven wrong. I cannot be wrong about this position because I got it from so-and-so, right? That's the problem we have in society today, is that, and that's why there's such a division, is because nobody's willing to communicate. All we're doing is trying to yell over the other person to try to prove that we're right. And the reality is that the truth always lies somewhere in the middle. Is there climate change? Sure. There are certainly some issues about climate change that are occurring, but a lot of the hyperbole probably is never going to happen. So there's a reality in the middle somewhere. And if you haven't taken a look lately, I think what's going on with Toyota and Tesla is a great example, right? If you take a look at what's going on with Tesla lately, just as a function of this, right? So this was the EVs, the whole guide right there around, climate change and building these electric vehicles. Toyota is building hybrids, and if you go take a look at NVIDIA and Toyota, they're polar opposites, right? Toyota is soaring through the roof right now. It's the next NVIDIA, because the truth about vehicles and climate change wasn't electric vehicles, it was the hybrid. And that was always where we should have started with to begin with. But see, nobody wanted to ever have that conversation. And now investors are starting to come along to this idea that hybrid technology and solid state, which is where Toyota is headed, they've got a big jump on this curve, is ultimately going to probably be one of the solutions down the road. And Toyota is getting rewarded for that. But see, the truth was in the middle. The truth was, yes, there's climate change. Yes, there's something we can do about it, but it wasn't these polar extremes. It was in the middle. And I think we're going to see, and that's where we should all be trying to get to as humans, is trying to figure out what the common middle ground is, but we can't do that. That's why we can't have conversations.
I totally agree. If you're not talking and you're not listening, it's not a path to progress. Exactly. All right. Like I said, we could talk about this forever. But I just wanted to note the importance of the milestone. All right. The second is, you know, my daughter recently graduated from college. She graduated from Cal Poly in San Luis Obispo, where if anybody knows of that school, phenomenal school. It's a jewel of a resource out here in California, and it's quite competitive school. It's very well known for being very rigorous in the STEM disciplines. And my daughter's got a couple of friends from there who had a real, they're having a real challenging time finding jobs coming out of there. And these are kids with engineering degrees. You know, they're interested in, you know, doing big stuff in engineering or with data. So jobs that are in demand. And it goes back to what I was saying earlier about, you know, we're being told how amazing this jobs market is and that there's still way more openings than there are candidates. But if you talk to people who've been losing their jobs in the layoffs that have been increasing over past months, or you talk to recent college grads, you really hear a different story. You hear like, hey, it's actually not super easy to get, you know, a job I want. You've mentioned many times that one example, the person who sent out like over 1,000, you know, resumes didn't hear back from one. So, you know, I'm beginning to see more and more examples in my personal life of competent, credible candidates who are having a challenging time, you know, getting hired. So, anyways, here's I'm getting to one of my crazy ideas, and I'd love to get your reaction to it. So
Here we go.
one of the bits of advice that I've been giving these kids is, you know, if they've got the ability to do this, which your maximum opportunity to do it is when you're young and you have, you know, no other responsibility or no other obligations in your life. I'm like, look, if you're having trouble getting hired for the job you want, create a short list of the companies you'd most like to work for, call them up and say, you know what, I'm going to work for you for free for the next month or two. Let's talk about a project that I can do for you that I will do free of charge, right? And because the currency you have that's valuable at that point in time is your time, right? You know, most companies are not going to turn down free help from, you know, a enthusiastic, bright, shiny, you know, person that wants to do the work. So, you know, in a lot of those cases, if you get the company to say yes, right, you work for them for a month or two and you show them what you're capable of, you've removed a lot of the risk from the hiring decision from them, but they'll generally either say, hey, you did really good work for us. And yeah, now that you've proven you fit in well here and we see what you can do, yeah, let's talk about creating an opening for you here. You know, or they say, hey, you know what, I'd love to hire you, but, you know, I just can't for reason X, Y, or Z. But let me reach out to some of my other peers in the industry who I know might be looking for somebody. I'll give you a recommendation. And now you as the candidate have real marketable experience at a big company in this space. And I've seen this happen over and over again. I've used it actually in my own life. When I was in my 20s, it really paid off. It's a great strategy. I think I've got a bigger idea to build off it, but I'm curious. I'll take a breath to get your thoughts.
No, it is. It's called internships, and
yeah,
they're great. Yeah, and look, you're going to ask a lot of people, hey, can I come intern for you? And there's going to be a lot of people that say no, but you know, as the old sales saying goes, everybody that says no, you're one closer to a yes. You know, you just got to keep asking people, you know, for that opportunity. And yeah,
right. Well, and you sweeten the pot by making it totally free. Hey, I'll do it at my time.
But look, there's a lot of companies that even if it's free, it's like, hey, I love the offer. I just can't right now. I don't have the time to dedicate to you, or I'm, whatever, right? There's going to be reasons why they say no. So just be prepared for that. But that's the whole point of sales, is that when you're making sales in real life, you're going to get a lot of no's on a sale, but eventually you'll get a yes. It's just an odds game. So, you know, I just don't want you to be discouraged that the first time you go out and ask for an internship, you get turned down. It's like, well, that didn't work out. I'm stupid. You know, I'm just saying, like, there's going to be reasons why they can't do it, but there's going to be a lot of reasons they can. And again, you just got to get to the right company, the right person, and do it. But it's absolutely a fantastic idea. Internships are awesome. I push my kids to do internships every year, and you know, get involved in business organizations. You know, the National Federation of Independent Business. There's, you know, the Rotary Club, the Chamber of Commerce. Get involved with those, because those are all business owners. So if you're looking to get in somewhere, get involved in the organizations that they're involved in, and get to meet them. And all of a sudden they go, oh yeah, you know, that Jimmy kid, you know, he's a sharp kid. You know, he's here at Rotary every week, blah blah blah. And when they start looking, and look, this happens in our business, is that when we have a position that comes up, we need to fill, everybody starts thinking about who do we know that'll be a great fit for that job. And if we can't come up with somebody we know, then we go out through the normal recruiting services, right? And start trying to recruit that way.
But if there's been a diligent hand raiser who's been hanging around saying, what can I do for you? Right.
Yeah, he's the first guy you think of, right? It's like advertising. Why does Geico advertise insurance 40 times a day on television? Because it's not that you need insurance today, but when you do, it's like, I need to call for some insurance. I'll call it Geico. I see them every day, right? It's all about repetition. And yeah, put yourself in front of these people. And that's why we talk about mentorships. We talk about, the network of people, and, look, go to networking functions. A lot of people at networking functions, they're just like you. They're all trying to find a job too. But you know what? If they get hired on to somewhere else and you've gotten to know them through networking and they have an opening, they're saying, hey, I know a guy that might be a good, or girl, right? I know a good person that might be a fit for this job. And that's just the way the world works.
Well, so let me get to my crazy idea then. So a big part of this is rooted in, I tell this to my daughters and their friends a lot, which is like, look, coming out of school, when an employer, a potential employer has no other basis for judgment, yeah, your degree and your college kind of matter a little bit, right? But a couple months after that, they don't care. All they care about is what you can do, right? Really to your experience, right? Like, so what can you do for me? And in most cases, I went to quite good schools. Once I was a year or so out of undergrad, nobody cared. Nobody asked me, right? They just wanted to know what I could do. So that's one of the things I really like about this internship is you are getting, even though it's free, you are getting marketable experience, right? Which is going to make you landing the next job. It's going to hopefully skyrocket your odds of landing the next job. So here's my wacko idea, which is, as you were saying earlier, Lance, colleges have metastasized to the point where they're just really expensive pieces of paper for way too many people, right? You get out, you don't really have any marketable experience. Nobody cares about your diploma. A lot of cases, those diplomas are in pursuits that nobody cares about anyway. Your employer doesn't care about anyways, right? So, and the kid is saddled with a ton of debt, right? And so I think, and I'm seeing it in real time right now. Kids are really beginning to question the value of going to college and making that commitment much more than they had in the past.
That is a huge mistake.
Yeah, they're looking at it and saying, I think college, maybe what I've been told is wrong, right? I'm told it's the pathway to riches, but I'm looking at.
Yeah, but see, this is the wrong attitude. See, what people think about college is that if I'm going to go to college, I'm going to walk out of college, I'm going to have $100,000 a year salary that's going to put me in the corner office because I got this degree that says I can, I'm a psychologist or whatever, right? That's not what a college degree does for an employer. What it tells an employer is that you can get up in the morning, you can commit to a project for a 4-year period, you can do the work that's necessary, you're competent at the work because you got decent grades, and you were able to complete that task, graduate in 4 years or whatever the time frame was, with this degree of skills. You don't learn crap in college about how to work a job, right? One of the best lessons I ever got was from my commencement speech. When I graduated college, the guy said, you have spent 4 years in college. You know absolutely nothing as you go out in the world. The only thing you have learned to do is to take a problem and go and find research on how to solve that problem. That is all you've learned how to do. Now go out in the world and get experience. And, this is the point that people, miss about the value of college. They have their expectations are misaligned with what the college degree actually gives you. If you're just wanting a high-paying job, absolutely skip college. Go to a trade school, learn to weld, learn to pipe fit, learn to do, any type, plumbing, electrical. Those will pay you 6-figure jobs, and you'll do very well in that trade going forward. You can build your own business out of it and do extremely well with that trade. But if that's what you're wanting right out of school, then go get a trade school. But if you're wanting a career, college degree isn't going to do that for you. What college degree is always going to tell the employer is that you can wake up on time, make your bread, and complete a project.
So I agree with you, but I do see that employers are beginning to change their opinions too, where they're like, with grade inflations and the way in which colleges have really kind of capitulated to a lot of demands of the special snowflakes that have been going through there, like we're not even sure these kids have learned how to tackle and research a problem. Like even that basic assumption on the employer side, I think is weakening. And here's where we get to my crazy idea,
Okay.
which is I think that at the end of the day, the real currency is experience, right? And of course, the challenge every graduate has who has their fresh degree is like, well, I've got the degree, but I don't have the experience. How can I get
Right.
the experience I
Look,
want if I just have the paper, right?
same thing happened to me when I graduated.
Yeah. So my idea is, I think this is going to happen organically. Yes, more kids will hopefully go into trades, but I also think you will begin to have kids who strike their own deals with employers rather than go to college. And they'll say, look, I'm 19, I can couch surf, I can live on ramen noodles at this age. Company X, I will work for you for a year or 2 years for free. And it's not an internship, it's an apprenticeship. I am going to give you, my full energies, and I'm going to figure out how to make it work economically. But you're going to teach me the following things. And so by the time I am done with this year or two agreement that we put together, I will have learned these fundamental parts of this business that I'm going into. And at the end of that period, I'm going to be skilled enough that I'm going to be a great candidate for an opening, paid opening at your company. Or I'm going to be able to go to one of your competitors and say, I just worked for company X doing, these things. I've learned these skills, whatever. Hire me now, right?
And that's fine, except that's going to be jobs that are going to be extremely limited in nature because you don't have the education for higher attainment. And look, and once you start trying to move up that ladder and the corporate world, that degree does matter. And it specifically matters, particularly in fields that require a lot of mathematical skills, et cetera. Like, for instance, you can't go to a law firm, work for 2 years for a law firm for free, and then become a lawyer.
No, there are some professions where you need the advanced degree, right? But you could go to law school. You could go to law school.
Right. Yeah. But you couldn't, you still got to wind up going to school and getting the thing, and you got to pass the bar. You can't go work for a hospital for 2 years and become a doctor. Right.
No, but
hold on. Let me finish. You can't go work for an engineering company for 2 years and become an engineer, right? Because you got to be certified. So look, there's all these things, and it sounds great. I'm not arguing the point. Look, if you don't want to go to college, then cut this bargain to go get experience, because experience is important. What I would argue is you go to college, you cut that deal during the summers to get experience during the summers, during the winter breaks, et cetera. When you're not in college, instead of off, during the summer, go get a job in the field that you want to work for free during the summers, go back to school and get those math skills that you need, get those science skills that you need. Because again, at the end of the day, it's like, look, my son's in engineering right now, and his life is miserable because it takes him 8 hours to solve one problem because of the calculus that he's doing right now. And these are very, very complex problems. And it's very tough, but this is how they weed students out of college very quickly, is these type of problems. But you're not going to learn that type of discipline and that type of math skill working for free in the summers, right? That's just something you have to learn in college.
So totally agree. I'm not sure these ideas, well, first, I'm not sure my idea. It's a good idea.
No, this is a good idea for some people. I'm just saying, if your level of attainment in the world is a much higher level, this isn't going to work. If you want to attain a level, then this will work, right? You can certainly do that. But there's going to be certain jobs you will never have access to without that college degree. And that's just, unfortunately, that's just how society runs.
Yeah, that's true. And it's super hard to get a master's degree, if you don't have a college degree to build off of that. So I totally agree with that too. But we're talking, averages here, right? And there's a lot of people who I think are going to be, they're not going to be doing higher level calculus, right, for their careers. And so not getting saddled with a bunch of debt for not a very useful piece of paper, something like what I'm talking about may work. And one of the things that kind of turned me onto this really early on in my career was when I went to Merrill Lynch, big investment bank, and I noticed that all the people at my level, the bottom rung, the financial analyst, you're right out of college, we all had like Ivy degrees, right? Then if you looked at the associates who had to go get their MBAs and then join in, there was still a fair amount of top schools, but there were less. And as you got higher and higher up the ladder, you were getting just random schools you'd never heard of, you know, Rochester Polytechnic or whatever, right? And at the very top, you know, I got to meet the CEO when I was there, and I'm not even sure he had a college degree, right? So, I mean, there are lots of parts, especially of the business world, where you don't need to be doing advanced calculus, you know, to be a good manager. And most of what you learn is on the ground, just solving problems and benefiting the expertise of others.
Absolutely. Look, you cannot underestimate the value of experience. Look, and like I tell my son all the time, you learn nothing in college, right? You don't come out of college with a skill set. You learn that over time through experience, you know. But you do learn how to do the requirements to make that to make that experience count the most. And that's the important thing, is that, you know, we devalue. So we've done two things very, very badly in our society. You know, when, you know, back in the 40s and the 50s, actually the 30s, 40s, 50s, you know, a lot of men didn't even graduate high school. They had like an 8th grade education, and then they went to work on the family farm or whatever it was.
Right. Or a construction site. Yeah.
Construction site, whatever. And that's fine, right? They had an 8th grade education. If you had a high school diploma back then, you were like, wow, Adam's got a high school diploma. He's the boss, right? We're putting him in. He's going to manage.
He's the foreman. Yeah.
He's the foreman, right? And so that was because so few people had a high school diploma. So then we said, hey, everybody should have a high school diploma. Well, once everybody had a high school diploma, that diploma no longer has value. And so we said, okay, well, people need to have a college degree. And so for a long time, a bachelor's degree was quite rare, actually.
Right.
And, you know, it had a lot of value. It's like, wow, Adam's got a bachelor's degree in business. You know, we're going to make him the CFO of the company. And so then we said, well, everybody needs to go to college. And so now everybody has a college degree. So now the college degree does, and this is why we're having this conversation, all of a sudden the college degree doesn't have any weight, because everybody has one. It's always supply and demand. I said this 20 years ago. I said the worst thing that we're going to do is require everybody to have a college degree, because that college degree is going to have no weight. And so now you've got to look at people and go, okay, do you have, look, even in my business, right? It's great you went to school. I'm glad you got a bachelor's degree in finance, but do you have your certified financial planning certificate? Do you have your chartered financial analyst? You know, do you have a master's degree? Because we won't hire you unless you have those pedigrees, because the college degree just doesn't cut it anymore. And it's going to be the same thing eventually with masters. It'll be the same thing eventually with PhDs. And the more that we require everybody to do this, and this is the fault of the parents and society and everybody else, because we pushed everybody into getting a college degree, is that we have diluted the importance of having that college degree. And so when you go to put your resume in with 5, and the other problem that we've done too is with companies like LinkedIn and with Indeed and Career Builder and all this, and all these companies now, go online and fill out your application, you know, and we'll get around to it. So the first thing to do is they put AI on it and they have it scanned. It kicks out everybody that doesn't have the exact build of the resume that the AI is looking for. And so a lot of people that are good quality candidates never even get a look, because every job's getting inundated with 10,000 resumes for one position. And that was never the case before. And so, you know, we've done technology, and we've always talked about how great technology is awesome. There's a very, very dark side to technology that we are now starting to see, but people aren't willing to admit yet that that's the problem.
All right. And we got to leave it there. That is a rant for another day. But we're getting real long in the tooth here, so I got to wrap things up. But thanks, Lance. Great discussion. Reason why I wanted to bring this up was because, you know, we do have some younger folks that watch this channel. Even though so many are 45 plus, there actually are Gen Zers and young millennials that watch and ask for more of this type of content. But also, like I said, you know, that 2/3 of this audience is older, yes, but they have children and adult children that are wrestling with the same issue, right? Which is, hey, I'm trying to get ahead, I'm trying to get hired, and this market just does not seem as you know, easy as we're being told, especially when we hear Jerome Powell talk about the jobs market. And then, of course, you know, if those of us that are worried that something harder than a soft landing may materialize over the next year or two, that just makes, you know, job prospects even more scarce. All right. So in wrapping things up, folks, just a reminder that the Thoughtful Money Conference on Saturday, March 16th, is coming up. We're still offering the lowest early bird price discount. So if you're thinking of participating in the conference, make sure you lock that in before it rises. And remember, if you're a premium subscriber to our Substack, you get $50 off the conference, off that lowest early bird price discount. So it only costs $15 a month to sign up. So you can play that arbitrage, spend 15, save 50. And a reminder too, Rick Rule just signed on for the faculty as well. And if you haven't seen Rick at the conferences in the past, he's great because Rick's such a phenomenal speaker to begin with. But he shares usually like 3 or 4 dozen specific tickers. He just goes through his entire watch list of the stocks that he owns and is monitoring, and shares that with everybody. So if you're looking for good natural resource investment ideas, Rick's going to give you plenty. Just a reminder, as we do, and I think we did multiple times on this channel, highly recommend that most people who are trying to navigate these markets and things from here work with a good financial advisor who understands all the macro issues that the guests on this channel talk about, as well as the ones that Lance and I do. If you've got a good advisor who's doing that for you, being a good financial quarterback for you, excellent, stick with them. But if you don't, or you'd like a second opinion from one who does, maybe even Lance and his team there at RIA, then fill out the short form over at thoughtfulmoney.com and schedule a free consultation with those guys. Like I said, it's totally free. There's no commitment to work with these guys. It's just a free public service that they offer. And Lance, it's been great to finally begin to start sending folks back out to you advisors. I've been getting lots of great feedback, both from the people that are talking to you guys, but it just does my heart well to know that people are getting good counsel from you guys.
Sure.
And I guess on that, I'd like to give you the last word here, Lance. So anything you want to say about the conversations that you guys are having with the people that are reaching out to you now?
No, it's all good. And, it's always important to try to, separate out, what your needs are, what you think your needs are versus what your needs really are. And, so we have a lot of people that come to us that, they're young. They're like, hey, I've been listening to this and I want to invest, in this. And we're like, hey, just keep it simple. I'll send you a long email that says, here's the steps you need to take. Start here, fully fund your Roth, fully fund your 401k, set up a spousal IRA, get these things funded. And then once you do that, then we need to start building an emergency fund. We need to build up an investment account. Then you come back to me and then we'll put your new proceeds to work in a portfolio. So, we try to help them out, just, not just saying, oh yeah, give me your money, I'll manage it for you. Cause it's not that we need clients, but we're fine. What we want to do is try to do the right thing for the people that come to us to make sure they're doing the right things financially to build their wealth.
All right. Well, thanks so much. And again, thanks so much for doing that. That's the huge part of the mission behind Thoughtful Money is to educate and enable. You guys are a huge part of the enable part of that. So again, thank you for that. And folks, if one of the best investments you make in your life each week is listening to this exchange of ideas by these two crazy guys, Lance and myself, please do us a favor and ensure these continue by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Lance, it's always great, brother. Thanks so much for hanging with me for yet another week here.
Yep.
Everybody else, thanks so much for watching.